The economic landscape has rarely been as confusing and as uncertain as it is today. For the last month or more, markets have been confronted with very inconsistent and sometimes shocking messaging from the Trump administration on tariffs and trade. One day talking tough, and sometimes within hours projecting a more conciliatory tone. Some observers downplay this as just a form of quote unquote strategic ambiguity or controlled chaos, all part of the Trump brand of the art of the deal. However one wants to frame this, one thing is clear. The resulting uncertainty has had a dramatic impact on market action and psychology. Indeed, we just closed out the month of April, and what a month it was. We saw a stock market that fell sharply to register a technical bear market, which is a decline of 20% or more in some indices, and some of the biggest one-day moves up and down in history. Moreover, investor and consumer sentiment got about as gloomy as it's ever been. And yet, the S&P 500 closed the month barely down on the month, just down about 1%, but still down about 5.33% on the year. In recent weeks, we've seen this uncertainty start to paint a potentially worrisome picture, including headline reports about economic contraction and job market weakness. And yes, along with this, concerns about recession, or even worse, have become more prevalent. If indeed we've reached that stage of the economic cycle, few would argue that markets have priced that kind of scenario in. So the implications to investment portfolios are massive. Hello everybody, John Llodra here. Welcome back to our channel here at New Harbor Financial Group. Today we're diving into a topic that's been keeping economists, market prognosticators, and everybody we know, everyday people, up at night. Are we on the brink of a recession or maybe already in one? Or could something worse be brewing, such as stagflation, the likes of which we haven't seen since the 1970s? Last month in my Are We at a Market Top video, I identified several warning signs that suggested we might be approaching a major market peak. In that video, I talked about how one of the warning signs, recession, wasn't yet checking the boxes based on the data that was present at the time. Being cognizant of recessions is important to investors, as this chart from my prior video shows. This is a chart of the S&P 500 going back to the 1940s, I believe. And what you see here, the blue line is obviously the S&P 500, which has risen pretty dramatically over that long period of time, but you see many major pullbacks. And the gray areas are recessions. And what do you notice, of course, and almost without fail, in every recession we've had, significant stock market declines. And in fact, the scale of this chart really underscores how significant some of these declines were. So for example, this decline in '01 or so in the tech bubble was bigger than what this appears on this chart. But the other thing to take away is recessions aren't the only thing. You can see in many cases, these stock market declines have started before the recession actually officially is dated. But nonetheless, keeping tabs on where recessions are, or whether we're in one, is a really important thing for investors to keep in mind. Since doing that video last month, we've gotten some important readings on the economic front. So I want to use this video to kind of update, including some really important reports we got this week, such as the Q1, quarter one, 2025 GDP report, and just today, the jobs report. I'm recording this video on Friday, May 2nd, 2025. So let's break down what's happening, what it means for your investments, starting with the GDP data that just came out earlier this week. What is GDP? GDP is basically a measure of economic activity. It's meant to measure the domestic economic activity, the spending, the investment, all that kind of stuff, sales. It's really meant to be a broad measure. No measure is perfect, and certainly GDP is not a perfect measure. Just a couple days ago, the U.S. Bureau of Economic Analysis put out the quarter one 2025 GDP report. And it was quite a shocker because the report came out to basically show a contraction, a decline in gross domestic product of 0.3% quarter over quarter. And you can see that on this chart here is the first decline in a while. This is kind of started to validate many people's increasing concerns about the economy, perhaps in response to the tariff and trade wars that are kind of being postured. But it certainly was a headline grabber. Now, I want you to note that this is the first release, and in fact, these kind of GDP reports get revised 2 or 3 times after. You can see here the next release is May 29th. So just understand that this data is subject to change. But let's dive in and dissect this report a little, because there's a bit more beneath the surface than the headlines would have one take away. So let's just look first at the equation for GDP. You can see there's an equation here, pretty simple. GDP equals C, which is consumer spending, plus I, business investments, plus G, which is government spending, plus this final term, net exports, which is exports less imports. And it's that term, the net export term, that got a lot of attention, or should be getting a lot of attention, because it really had a dramatic impact on the GDP reading this quarter. And that's what this chart shows. You can see here that net exports actually were highly negative, meaning we imported a ton of stuff, if you will. In fact, I think it was negative 4.8, let's call it negative 5% contribution from net exports. Now, the big reason for that, almost nobody would debate, is that there was a lot of front running of importing of goods and materials and products in a race ahead of proposed tariffs. So there was a massive importing, including things like gold. We've talked about that. The gold imports alone contribute to a lot of this. Now, it would be tempting to completely write this off as a one-time thing, but the reality is that some of these terms here, the consumer spending and investment by businesses, these imports are reflected there. So it's not quite as easy as completely brushing off this net imports as a one-time factor on GDP, because some of it's in there. But the takeaway here, though, is that the headline GDP number wasn't quite nearly as bad as it would appear on the surface. Now, many folks define recession simplistically as 2 consecutive quarters of negative GDP reasons. So just even based on this somewhat noisy GDP first quarter of negative growth, GDP readings aren't quite yet enough to even meet that kind of basic definition of recession. But it's important to note that GDP itself is what we call a coincident indicator of recession. It doesn't predict recessions. It's when GDP goes negative in this way, in consecutive negative quarters, we're usually already in a recession. In fact, the bureau that is charged with officially dating recessions, the National Bureau of Economic Research, uses a much more textured set of inputs to define recession. And many of these inputs are not captured in the GDP. Things like manufacturing trade sales and leading indicators and things like that. So it's a bit more textured than that. And the other complication here is that even when the NBER dates a recession, it's oftentimes retrospectively. Okay, so they may say, hey, we entered a recession officially starting 8 months ago. So I don't want to downplay the importance of understanding where we are in a recessionary cycle, but it's an imperfect science when it comes to calling outcomes for investments. But the GDP data is kind of a little bit of a mixed bag right now. So how about the job numbers? Another key input on the economy. Those job numbers came out today. And actually, it was quite a surprisingly positive report. There was a lot of angst in the market. Folks were expecting the possibility of a really weak job report today that, frankly, if it were to happen, probably would have sent the markets reeling to the downside. But instead, the jobs numbers came out significantly better than expected, and the unemployment rate stayed steady. So this is a big sigh of relief, especially because there's been so much angst about the job market and rising unemployment, especially the federal government sector due to things like the DOGE cuts that were talked about. And here again, though, the job market is a key metric of economic health, but it's actually a lagging indicator of recession. Typically, when the job market starts to fall apart, and we see it in the job numbers, we're already in recession. So it's important to understand where we are, but oftentimes the job number is again, a lagging indicator of recession. Let's talk about corporate earnings. We're in the midst of Q1 corporate earnings season. And we've had kind of a mixed bag, but there's been actually a pretty robust set of earnings. Earnings have beat expectations more than they've missed for company reports thus far. We're only about, I think, midway, maybe closing on 2/3 way of the companies reporting this quarter. But if there's one area that has been a little concerning, it's in forward guidance. There's generally been a trend of increasing caution and weaker forward guidance. And actually, some companies are yanking guidance altogether, basically saying they can't look out beyond the next month, never mind the next quarter or 2 or 3. So that's the one area that we're starting to see some concerns. Just this week, we got some major earnings reports. We had strong numbers out of Microsoft and Meta, but we also got weak numbers out of Apple and Amazon and even McDonald's. So that's a concern because McDonald's in some ways is maybe an economic measure that covers a broader swath of the population, including lower income folks and folks maybe aren't represented in the kind of high ticket items, discretionary consumer products like luxury brands and things like that. So there are some mixed bags in some of the earnings, but yet it's still not a major warning sign of impending economic contraction. So while watched indicators like GDP and job numbers or earnings haven't convincingly signaled recession yet, other leading indicators, things that measure psychological factors and sentiment, have painted a much more concerning picture. For example, there's a large alternative asset manager, Apollo Group. They estimate a 90% probability of recession. That showed some dramatic declines in important leading indicators like manufacturing surveys, CEO confidence, plans to cut back on business capital expenditures, and things like that. And perhaps even more worrisomely, they highlighted some evidence of cost pressures, suggests we could be heading into what we call a stagflationary environment, not just recession where growth is slow and unemployment rises and things like that, but it's accompanied by increasing costs of inputs for businesses and products that consumers demand. It's a particularly nasty economic condition. And, some of the data that Apollo puts into their presentation makes a pretty convincing case that we could be facing that. It's a mixed bag right now, but there are some convincing data. So this is a chart of the S&P 500. It's a daily chart going back a year. Each one of these candles, as we call them, these red and green or hollow bars, are a day. And this vertical dotted blue line here is the calendar year changeover. So here to the right of that is 2025. You can see we peaked on the S&P 500 at about 6147 on February 19th. And then we saw a pretty dramatic sell-off into the first part of March, followed by a swift rebound, and then a more dramatic sell-off, the main catalyst of which was this event here on April 2nd. This is so-called Liberation Day, when the Trump administration came out and shocked markets with much more dramatic and extensive tariffs than anybody had been predicting. We saw a very swift sell-off in the stock market, and there were some kind of policy ramifications or changings in response to that. I'll talk about it in a minute, but it wasn't the stock market sell-off, we believe, that caused some backing off of the tariffs and putting some 90-day pauses, but it was really the bond market, and we'll talk about it in a minute, that freaked out more or less and caused some changes. But since then, we've seen a bounce and then a pullback and a pretty solid bounce here. You can see this little bar here today is up. That's the positive reaction to the jobs market numbers that came out today. Now we're in a key area. As you can see, the diagonal line was a downtrend line that we broke out of just about a week or so ago. And we had a steady decline here, steady rise here, including this gap higher here, and then today's up market. We're at some key levels of what we call resistance. This is so far has been, you might say, a fairly typical bear market counter rally to resistance. What we mean by resistance here, these various lines here, this gray one, this green one, and this orange one, are what are called moving averages. You have the 50-day moving average here in green, the 200-day moving average in orange, and the 100-day moving average in gray. You can see we've gone higher than the 50-day moving average, poked above, and now are right at the 100-day. We're above the 200-day, but right at the 100-day. The simple takeaway from this, getting away from the technical mumbo jumbo, is we are in an area where this is a key proving ground for the market. There's a decent probability that this resistance area proves to be formidable. That this bounce here has already priced in some of the relief rally we've seen in some of these numbers of job numbers and things like that. And we could pull back here, consolidate. We could certainly retest the lows, even though I think it's a little less likely than perhaps we thought even maybe a few days or a week ago. But if we break above these levels convincingly, not just one day, but if we start to substantially break above these moving averages and stay up there, we absolutely think the all-time highs here back in February are in sight, and we could even take those out. And that's even with an economic picture that remains murky. This is a daily chart of the interest rate on the 10-year Treasury bond. Now, what you can see is back on January 14th this year, that interest rate peaked out at 4.809, 4.81, let's call it. There's on this chart, the decimal place has to be moved over one spot. And then you saw a prolonged period of declining interest rates here. This, in fact, was probably one of the most intended policy outcomes of the Trump administration. Secretary of Treasury Scott Bessent talked pretty vocally that, hey, we need to get interest rates down. In fact, without mincing words, essentially, one way to do that is to create economic contraction, to create a scare in economic markets to cause growth to slow down and interest rates to pull back. So in some ways, mission was accomplished here until here. In the wake of the Liberation Day tariff announcements, interest rates spiked quicker than we have almost ever seen. In fact, they spiked up to just about 4.6% right here. And that, we believe, is the thing that spooked the administration to walk back the hardline talk on tariffs. A stock market pullback. We're still not that, even at the lows of the stock market, we hadn't pulled back meaningfully from all-time high record valuations. So that wasn't so much a concern, we believe. But the bond market was really starting to show some stresses, and that ultimately is one of the main objectives of the administration, to get those interest rates down through whatever means possible. Now, we've seen interest rates start to pull back again, but in just recent days, we've seen these interest rates start to climb up again. The strong job numbers today, some of the economic data has given rise again to fears about inflation. Market expectations of additional Fed rate cuts have now been pushed back later. So this remains to be seen. We're likewise at key technical levels on interest rates. If these poke up and start to threaten to the upside here again, that could be a problem for the administration. Certainly can be a problem for the stock market if interest rates get higher, because what it may certainly be telegraphing is inflation and some other concerns that are far broader than just what corporate earnings are. I'd like to transition now to a chart of gold, and specifically the gold mining companies. These are companies that mine gold. Now, gold hit record levels several times in the month of April, hit essentially $3,500 an ounce, and gold miners also saw very strong action. We've been long bulls on precious metals, including the gold miners, which we hold in our client portfolios. And you can see here, this is a weekly chart. The move higher here so far in 2025 has been dramatic. Now, we did get a pullback here, and frankly, it's a pullback that we thought was highly likely. In fact, we hedged our gold mining exposure right around this level in anticipation that we would likely see a pullback. And just yesterday, we took some of those hedges off. So now we have call options, and the hedging we did is we took in premium by selling call options on our gold mining stocks to buffer that downside. Just yesterday, we moved those call option strike prices higher to, we had 53s and 49s. Now we have 53 strikes out in June and moved up to 56 strikes in July. So here we have, we do think there's a decent likelihood we get a continued rise higher even if after a short period of consolidation. So we feel really good about that. So given what we're seeing in market action right now, and given what's going on in the economy, what do we recommend right here and now? Well, certainly we're expressing this in how we manage portfolios for our clients, but make no mistake about it, we are in a very still uncertain time. I mean, the policy uncertainty and tariff uncertainty is still there. So we do still think most folks, especially those in retirement, and anyone that was really concerned and sleepless during the sell-off of the last month, absolutely think about reducing risk. This is a perfect opportunity for doing so. We've gotten a really nice rebound in the stock market. Not to say it can't go higher. Talked about those technical levels that if we break through, we certainly could see new all-time highs or even more. But given the uncertainty, people shouldn't be a hero. We're not making big bets on taking out new all-time highs. It's possible, but it's just as possible that we turn back here and retest the recent lows. So underweight stocks, we're underweight stocks. We have about 45% stock exposure. We did add a little bit of additional stock exposure in Latin American markets earlier this week. But we're still very underweight stock, and we do have hedges. We have some call option hedges where we took in some premium to protect the downside. So it's a great time for tactical hedging for those that are watching. The other thing we would say is we still think it's a good idea to be underweight long-term bonds. There still is this ever-present concerning picture about sticky inflation, and some of the earlier comments I made about some stagflation concerns, that's something that we think warrants underweighting long-term bonds. And we still think being in good, healthy dose of short-term treasury bills to keep safe, but also to provide dry powder to deploy when other opportunities present themselves makes a whole lot of sense. We're going to continue to recommend diversifying into precious metals and broad commodities. We have broad commodity exposure as well, to the tune of about 5% in our client portfolios. And also, we do think that we're in the very early innings of a meaningful shift to outperformance of global non-dollar denominated assets, both global stocks, and foreign bonds. The dollar has weakened pretty substantially, and we think there's a good chance that it could weaken furthermore. So we do think systematic diversification into global non-US dollar assets makes sense. We've started to do that. And the valuations of, for example, most foreign stocks, especially emerging markets and some areas of the developed world, are far better than US stock valuations. We still remain, even with the pullback this year in the US stock market, at amongst some of the most highly valued markets of all time. But we are in the early innings, we think, of outperformance of global non-US dollar assets. It's too early to say definitively whether we're in kind of a recessionary or a stagflationary environment. But what typically does good in those things? In a pure good old-fashioned recession, bonds tend to be good because you start to see economic weakness. You start to see interest rates, the bond markets start to be less concerned about inflation and things like that. And those bonds become a safe haven, and interest rates oftentimes will pull back, which is good for bonds. As interest rates drop, bond values go up. Where doesn't typically do good in a recession? Well, stocks tend to struggle because earnings start to contract, multiples start to contract. Typically, there's a shift to favor more defensive, non-cyclical sectors rather than growthy things like tech. And commodities can be a bit mixed bag depending on policy responses. Oftentimes, as we've seen over the last decade plus, when a recession type environment takes hold, we see strong stimulus measures, both fiscal and monetary. Those can be great tailwinds for things like precious metals or commodities or things like that. So something to watch there. Stagflation, probably the most difficult environment of all. And again, still remains to be seen if we're truly looking at the possibility of a stagflationary environment. Or perhaps the best way to illustrate the challenge there, and the reason it's challenging is because there are no simple policy responses. Stagflation basically combines the slow growth, no growth, high unemployment type things of a recession with high inflation. And the problem with that is the policy responses that are available, things like lowering interest rates to stimulate economic growth, have the effect of maybe helping with the growth side of the equation, but they also have the effect of exacerbating the problem of inflation and making things worse. So that's a very, very tricky environment. First thing I'd like to call out is, and this shows returns in the 70s for both nominal as well as inflation adjusted real. First thing I want to point out is the assets that most people hold the most, the stock market as measured by the S&P 500 and the bond market as measured by 10-year treasuries, they actually lost money on an inflation adjusted basis. So the two single largest asset classes that most investors and investment advisors, frankly, advise their clients to be in, did horribly during stagflation of the 70s. What did well, and again, there's no guarantee that the past represents the future, but what did well, things like commodities, hard commodities, things like energy commodities, gold, and things like that. Copper tended not to do well because copper is a very economically sensitive metal. And when the economy slows down, copper demand falls off the cliff. So I hope you found this video helpful. We have a very murky environment. Still suggests highly alert and safe investing. We're certainly being highly conservative and tactical. We don't recommend anybody be all in anything in this market, and certainly not the stock market. We'll keep watching markets and reporting on them as we see them. If you found this video helpful, please like it, subscribe to our channel. We welcome your comments. Please just comment away liberally. We love feedback as to how we can improve these videos going forward. But until then, I want to thank you for tuning in, and I wish you a wonderful day.